And if indeed the SLV ETF have been selling their shareholder silver into the market, they're going to run into a problem. And the problem is going to be the demand for delivery. And it was interesting that Larry Fink was accompanied by his entire board of directors um, of BlackRock, and it said they were there to talk about regulatory reform. And it's difficult to say exactly what they talked about, but I've never ever seen a scene like that one, where essentially the CEO of a financial company shows up with his entire board of directors for discussion with the Prime Minister of England. It's
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with David Jensen. He's been on before on this channel. Last year, we spoke about how the LBMA has an endless supply, not just of paper silver, but also of paper gold. So, David, Happy New Year.
Happy New Year, Mario. Nice to be with you again.
Thank you. And before we go further, I just want to share here something with you, David, and the viewers. And it's a very long-term chart of the price of silver on an annual basis. And it goes back to 1802. And the point of this chart, and the reason why I'm showing it, is that yes, it has been frustrating for silver stackers, seeing that silver is still trading around $30, and we got up to 50 in 1980 and also in 2011. But if we look at this chart, it's a closing basis chart, and back in 2010, silver closed the year at 30.91. So that's the highest ever closing level on an annual basis for silver. And then in 2012, we had 30.28. So what I'm trying to say here, sometimes it feels like, yes, you want to give up. But I think
Mhm.
this chart shows that we're almost there in terms of the whole thing unraveling. And it's interesting that you can see here the pop in the price of silver during the Civil War. And then I guess you had the great crime of 1873. And
Right.
it was, yeah, it was a bear market in the price of silver until 1932. And this price here, 129 roughly, that it was the constitutional level for silver. That was the weight of silver. One ounce was $1.29, and they're able to keep that up until 1964 or thereabouts, of course. So with that, David, just wanted to ask you maybe to explain to the viewers briefly what you mean by the LBMA's endless supply of paper, and why the LBMA is so much more important than the Comex
Sure.
as far as silver is concerned.
Yeah. Um, the LBMA, unlike the Comex, is a physical market in that LBMA estimates between 90 and 95% of the trading there is spot or cash trading for silver. So you're not buying a future bar delivery, you're buying immediate ownership. And that's an important distinction. So notionally, all these holders, and to give you a sense here of the volume, the London daily volume in silver, they're trading um, roughly 202.1 billion ounces of silver every day in London, 2.1 billion ounces. And that's almost three times the annual silver mine supply on a global basis. So when you look at trading 2.1 billion ounces, what that means, they're trading immediate ownership with immediate ownership, immediate delivery, a 2 day lag into the local London market. It's impossible, given the scale of this trading, that the metal is actually there, just because of the tremendous ratio of the silver traded versus what is in the London vaults. There's about, in round numbers, about 850 million ounces in London vaults, and 550 million ounces of that is owned by the ETFs. That leaves 300 million ounces not claimed by ETFs, and of that 300 million ounces, much of that is owned by individuals and companies, funds who aren't interested in selling into the market. So what we've seen here in London is that in the last 3 years, since middle 2022, is that the vault holdings have been flat in London. They haven't moved up or down. Yet during this time, there's been a 500 million ounce global deficit of silver in terms of what's available to market from refineries and the miners. Subtract the demand globally, and there's been over 500 million ounces that's had to be drawn out of global bar stock, what's been held in vaults. And yet during this time, the London vaults have been flat in terms of their holdings. So we can see there that the London silver is illiquid, and yet every day they're trading 2 billion ounces of immediate ownership of cash silver in that market. And that's really where the divergence occurs, that the numbers don't make any sense. And we can see from that the insane volume that they're trading is that they're trading promissory notes, anticipating that they will be able to keep the holders satisfied enough that the scheme doesn't come unraveled. And it comes unraveled when people ask for delivery, of course. That's when these leveraged Ponzi schemes fail. Is that people say, well, thanks for the promissory note. It's a immediate ownership, of 1,000 ounce bar. I'll take delivery now. And that's what terminates that type of a scheme.
And how do you explain that then? That how does the this trading, how do they get away with it, discouraging people to take delivery? Is it because they're just trading to make a fiat profit, or they're discouraged by the bullion dealers into taking delivery? Yeah.
Well, I mean, the global sources have been near adequate enough, pardon me, that they have met global demand over the last 5 years, especially as the squeeze has started. But Mari, we can see that from the lease rates, for instance, in London, that the implied lease rates, which are derived from a comparison of various futures contracts, is that we can see that they are at a level now. If you scroll down to the next chart, there should be one more that shows a longer term one. Yeah, we can see there that the lease rates there at roughly 2% on a 2 month tenor silver lease, and that's the traders, when they're asked for delivery, will borrow the metal and then try and source it somewhere else. But we can see that since 2022 that there's been high lease rates in London. They compare to the lease rates during the Great Financial Crisis, the peak of them. If you look to the far left there, you can see they peaked out in late 2008 at roughly 3%, but they're up in that 2 to 3% range now and have remained there since 2022, while at the same time that we've seen this flatlining of the silver inventories in London. And the flatlining, while there's a global deficit, tells us that the London vault stock of silver is illiquid. It's not available to market. There might be, I don't know, 10 to 50 million ounces available, plus or minus, but overall, that silver is either held by ETFs or held by private holders who aren't looking to sell it for fiat into the global market.
So would you say that keeping an eye on the implied lease rates, let's say if they spike above 3%, which looks like a interesting resistance, would that imply that there's like a kind of a run on physical silver in London, and that people are scrambling for it? And
Yeah.
where would they get the silver? Because the Chinese and the Indians, they're also scouring the planet for silver.
Well, yeah, so I think we look at a plethora of indicators.
Sorry, sorry, David. Um,
There we go.
I think I muted you by
That's
mistake.
all good.
Sorry.
Yeah,
So,
so we look at a plethora of indicators in the physical market, and we look at the premia, including the big markets, which are India and China, and we can see these the premia in these markets are starting to move up at the same time that the lease rates are increasing. So this is not a localized shortage that we're starting to see. We're seeing a coherent move upwards in these physical indicators in all of these markets. And you know, it was interesting. The Silver Institute just increased the global net deficit of silver for last year for 2024. They increased it um, after the fact of and increased it by about 30 million ounces. Um, and I'm anticipating a similar level of global deficit in silver or more this year. And I think that the thing that's driving people towards this is the global currency debasement that's happening now. Um, we see the bonds are being sold off in the U.S. dollar bonds. You know, bills, notes, and bonds are all being sold off short term to long term, forcing global interest rates up, increasing the Dixie, the US dollar index versus all the other currencies. So we're seeing a global debasement of currencies versus the dollar and versus real assets. So I'm anticipating that we're going to be seeing much greater demand for physical silver in the year ahead. So 280-ish, 85 million ounce global deficit this year, beyond what was available from refineries and recycled silver and mined silver. And I wouldn't be surprised to see approaching a 500 million ounce deficit this year. And given the dire situation in London with the vaults being as dry as they are, I think this could have a quite a quick resolution as the market starts to awaken to this, and then we'll have a lifting of the veil of the London physical market fraud, which has been in place essentially since 1987, when Margaret Thatcher essentially gave oversight of the London gold and silver markets to the Bank of England, to the money printers. And that was so gold and silver have always been the warning systems of loose monetary policy by the central bankers, by the money printers, and the fact that that was handed over to the money printers in 1987 and has been there since. It essentially allowed them to have free reign over interest rate policy, and run it down to, we've before 2022, it was essentially at 0% for the better part of a decade, right? So now we have the comeuppance to these market interventions that have been put in place by the central planners.
sorry about that. Yeah, you mentioned 1987, and that was the new regulations that, well, it was called the Big Bang.
That's right.
Yeah, and deregulated a lot of the city of London, but like you said, they've allowed basically the bullion banks to self regulate themselves, and they can just do whatever they want, like this paper game. Have you got any idea of what kind of price we could see for silver when this thing blows?
Very difficult to say, Mario. It's
Yeah, no, I agree.
we we have currencies that are in flux. Um, I think we'll see a redux of the 1970s with a run higher in interest rates. Therefore, indicating that bonds are being sold off. That's what's happening right now, is that bonds are being sold off And I think that as the interest rates bite harder and harder on this globally over leveraged economy, that we're going to see the equity sell off at the same time. It's everything's run on leverage and speculation, and the cheap money is being taken away after decades of intervention by the central planners to uh, essentially, humanity's it's been like a foie gras duck, basically having this debt rammed down their throats with a tube, and we're now coming to the situation where we've got $300 trillion of global debt with spiking interest rates, and that's not a recipe for good times, right? So basically, we'll see now the consequences of many decades here of looser and looser monetary policy, more and more debt globally, and the suppression of the warning systems. It's like they essentially had a nuclear reactor, if you want to compare the world monetary system to that, and they basically turned off the two key warning systems and then ran the reactor at let's say 150% of rated power and talked about how wonderful they were at controlling inflation and creating this new global economy. And the veil of fraud is being lifted rather quickly with the availability of the internet to transfer information. So it'll be very interesting to see where this goes.
Yeah, back in 1980, of course, silver spiked to 50, and then for 20 years plus, it was like in a bear market.
Yeah.
What do you think is going to happen this time when everything blows? And of course, we don't know at what price silver will be, but do you think it's going to be worth selling your silver for whatever currencies they have, or it will be something like quite a change of paradigm where silver becomes worth a lot more and it stays there in terms of purchasing power? How do you see it?
Well, we basically had an existent paradigm of using debt-based fiat currencies as our measure of value, and thus the reference to selling silver and selling gold, um, because we've been using fiat currency as the measuring stick, and I think what we understand now increasingly is that the fiat currency system is a fraudulent and a manipulated system. And I think what's going to happen now is that gold and silver, which both have a 4,000-year history as money, and money has one of the four characteristics of money is it must have intrinsic value as compared to a fiat currency. But I think that the demand for money is going to reassert itself on a global basis as well. And so I think that the most important dynamic to keep in mind is that there's going to be a need for money in the future as this we can see truly how much monetary inflation has gone on for these approaching 4 decades now, where the central bankers ran rampant. Much of the monetary inflation, they called it beneficial inflation, but the money printing ran into and was sequestered in financial markets and in asset prices, including housing prices. And we're going to understand hundreds of trillions of dollars have flowed into those asset sectors, and how little of that is going to come out now and roll into real asset prices, and trigger a sudden revelation of the decades of monetary inflation, fiat currency inflation that has been going on. So I think it's essential to have gold and silver because there's going to be times where things that are needed for our own sustenance can only be acquired from the sellers with gold and silver money because of the revelation of the fiat money fraud that and really how valueless that is due to the past abuses.
So how are you preparing? Have you been stacking physical gold and silver? Have you looked at mining companies as well because they hold those? those minerals in the ground.
Yeah.
That's something you look into as well.
Yeah, I have two private mining companies that I run, and I was running a public mining company in the past, but looking at all this information over the years, Patrick Byrne and now David Rogers Webb is warning us of the same thing. Pardon me, but Patrick Byrne warned us back in 2008 of the problems with these depository trust corporations and how people were going to lose their assets. And I think, given the fact that we've got this enormous leverage in the banking system and this built-in time bomb built into the public equities, I'm trying to get assets out of the system, and thus I've invested my time and my sweat equity and my capital into my mining companies, into gold and silver mining companies, and that has been my focus, Mario, in terms of maintaining personal wealth and growing wealth in a very difficult time.
So yeah, privately held mining company. Yeah,
Yeah.
interesting. And
I
also
think the average person, they're the average person who can't do that, um, they do have access to bullion to protect themselves, and that's going to be absolutely essential going forward.
I agree with you. And just another question before we wrap up. You spoke in one of, I think the latest Substack, and before I move forward with the question, just let the
Mhm.
viewers know that David Jensen is on Substack if you want to look
Mhm.
into his research. But you spoke about the fact that what's his name, Larry Fink, the CEO of BlackRock, recently visited the Prime Minister of the UK, Keir
Yeah,
Starmer. And can you tell us why? Of course, this is speculation of why he's here, and it's got to do maybe with silver, right?
I, the indications are that there's something unusual going on. I mean, Starmer, um, who is about as popular as Larry Fink these days, they've met twice in a 1 month period in last fall. They met once in New York, and then Fink within 30 days was over in London with his entire board of directors of BlackRock. And as you know, we're trying to put the dots together and figure out what exactly could have been going on. But I think that I think it's of note that Jeff Curry of Goldman Sachs in 2021, he said during the silver squeeze, the Wall Street silver movement, if you want to call it that, he said he Jeff Curry was dismissive, and he says retail investors will never move the price of silver, and he said because they buy ETFs, and he said that the ETFs turn around and sell that silver that they hold for their shareholders into the market. They short it into the market. And he was claiming, of course, that they were hedging the silver that they held. But an ETF has nothing to hedge, right? They make their money on the VIG of what they charge their shareholders for holding silver in vaults. There's the risk is held by the ETF shareholders who are long silver. So that note, keeping that in mind, what Jeff Curry said was that these silver ETFs, and by the way, that BlackRock is by far the largest of the ETFs. They hold, I think, about 70% of the in their SLV ETF, the iShares ETF. They hold about 70% of the world's ETF silver. I mean, that would be the first place that I would look. And the potential is here. I mean the analysis I've done of the LBMA market data, using their studies and their statistics, the data that they put out is that there's between 4 and 6 billion ounces sold in these spot contracts, in these cash contracts into the London market. And with this sustained high lease rate and increasing silver deficit over the last 5 years, the odds that there's going to be a default in London is increasing. And if indeed the SLV ETF have been selling their shareholder silver into the market, they're going to run into a problem. And the problem is going to be the demand for delivery. And it was interesting that Larry Fink was accompanied by his entire board of directors um, of BlackRock, and it said they were there to talk about regulatory reform. And it's difficult to say exactly what they talked about, but I've never ever seen a scene like that one, where essentially the CEO of a financial company shows up with his entire board of directors for discussion with the Prime Minister of England. It's quite interesting that happened. But you can imagine that the regulatory reform that one might be looking at is looking for reform in the London silver and gold market. But there's a problem there, is that the London silver and gold market that the Bank of England set up is a private market. It's over the counter. There's no major exchange overseeing things like the Comex, and all of these 4 to 6 billion ounces of silver contracts that are being traded and held in the London market are party to party. They are private contracts, and they are governed by common law and contract law. And the relief that Fink would be looking for, if he's looking to have these claims annulled because of what they're doing to his ability to sleep, is to override common law and contract law, and that's impossible. The Prime Minister is under the common law, and the relief being sought would be to nullify these claims in London. And I just see it as a very, very difficult situation now that's arisen. And super interesting to see the premia going up globally for physical silver, and the implied lease rate going up for silver. There's enormous stress in this market, despite what the talking heads say. And so, I mean, we saw what happened to Volkswagen stock, what was it, 20 years ago, when there was a squeeze on that stock. And I think it ran from, I think, about 70 to about $1,200 due to a short squeeze. And everybody knew it was going to come back down again. And yet it went bananas like that. And I'm expecting something similar to happen with silver, except I don't think it'll come back to where it is. I think it'll go much higher than it should be, and then come down to a level which reflects global supply and demand for the metal. And it's going to be very interesting because there are 25 billion ounces of silver above ground in various uses, but not available to the market because it's not in the proper form. You need 1,000-ounce bars and kilo bars of refined silver from approved refineries. And the way I envision it is that the people have been kept naive and have been kept investing in the financial system and in financial assets, allowing companies like BlackRock to skim profit out of their activity. And I think there's going to be an awakening here as to the banking fraud, the fiat currency fraud, and the financial market fraud that's been going on, and that individuals are going to recognize the value of holding an asset which is nobody else's liability, which is silver and gold. They just are what they are, and they're recognized globally by humanity as having value. And it's very difficult to set numbers in terms of current potential currency price, but we can imagine if you had $500 silver, that it would be more than enough in terms of a value, in terms of being a private money form that it could allow people to carry on their day-to-day transactions using that metal. Throughout history, silver was the primary monetary asset and not gold. It refers, you referred to the crime of 1873, where silver was demonetized and really trapping people who were in debt. of having to source gold to pay off their debt. But I would not be surprised to see this 25 billion ounces, a portion of it, start to circulate in the global economy. And this is a real problem for the central planners who, they've got, as we know from the World Economic Forum and the UN and other organizations, the central banks, the Bank for International Settlements. The plan is for us to be migrated as a herd into central bank digital currency, and a social credit scoring system to essentially lock down humanity and be able to control them. And this is ultimately the kryptonite for these plans. And I think we're going to see this because of the meta stable situation that we have in these markets, that we could see the unraveling happen quite quickly. And the trigger is going to be a physical demand, and silver by far is the most lopsided market that I can see out there in terms of the claims versus the available physical stock.
So basically, what you're saying, silver could free humanity. I mean, that would be one for the books, and that's why I'm continuing to stack. I do have some mining stocks in the public markets, but
Mm.
I'm willing to take the risk that it will be there. But and that's why I focus more on having the physical. So, David,
In my view, Mario, there's a reason that silver is still trading at 60% of its 1980 high price,
yeah.
because it was recognized that this was the day-to-day vehicle. Milton Friedman noted that silver was by far the most historic monetary unit. Gold was the metal of kings. Silver, what was used day to day to pay for rent, for firewood, for food, etc. It was the metal and the money of commerce. And basically, silver had this big fat banking sector sitting on its head since 1987, and there's been a wild monetary financial market spree that has been operated in the meantime, while silver was prevented from sending the signal and giving an alternative, which was safe for an asset held by investors. The asset that is nobody else's liability and that is not part of the financial system, that allows individual holders to walk freely and make independent decisions.
I mean, we could actually see the gold silver ratio go right through that 15 level if the silver suppression unravels. Could you see it going
Easily.
down to like 10 to 1 or maybe even lower?
Well, yeah, the mining supply ratio is 9 to 1,
Yeah,
right? Gold versus silver. It's, plus or minus 90 million ounces of gold and
yeah.
820 million ounces of silver that are mined a year. So, I mean, it could get worse than that. It could go below 9 or 10 to 1. Nobody knows.
Hmm.
But the leverage situation is astounding when you go through the LBMA's numbers of what's in the vaults, the volume that is traded daily, the insane 2.1 billion ounces of cash silver contracts that they're trading a day there in London. Um, and by implication, the open interest of 4 to 6 billion ounces of claims of standing claims in the market. And then you look at the London vault stock. I mean, there are other vaults in the world, but that's supposed to be the primary vault stock to back the physical silver market in the West. And when you think that they've got 300 million ounces that aren't claimed by ETFs, and that 300 million ounces appears completely illiquid because it's not moving over years of sustained and increasing silver demand deficit in terms of, silver supply deficit. I think we're going to have between 250 and 500 million ounce silver deficit this year. We'll see as the statistics come out, but um, it's going to break at some point, and we're very, very close. We can see that with the multi-year sustained high implied lease rate and the growing premia in the physical centers in India and China where people want the metal. They don't want to hold a paper or digital certificate.
Talking about ETFs, I have a lot of followers of the channel asking sometimes which ETF they should buy, and I say
Yeah.
no ETF. But I think there is one though, PSLV, which is like the
Yes.
Sprott one. Is that the only one you would recommend?
Well, if I was to hold an ETF, which I would, which I won't, um, I would take delivery of the share certificate, number one, because of the problems that David Rogers Webb and Patrick Byrne have pointed out. Um, but there's a there, so I think the Silver ETF is a valid and good asset. The challenge that I see is that their silver is held in the vaults of the Canadian Mint, the Royal Canadian Mint here in Canada. And as these crises grow, you hear the saying, desperate times call for desperate measures. And the financial sector is going to start to whine as they get into more and more trouble. Because if we look at this, let's use the low number in terms of the estimate of the total short that's in the market of 4 billion ounces. If you have $100 move in the price of silver, that's a $400 billion increase in the liabilities on the balance sheets of these institutions that have been shorting silver. And it's going to trigger detonation of ETFs and of the bullion banks that have been playing this game. And so the challenge is that the asset that can maybe stave off or ameliorate or slightly reduce the problem for these bullion banks, who typically the banking financial sector are amongst the largest contributors to political campaigns. They're in there and they have these elected officials acting at their behest. I mean, you're certainly not going to meet with Keir Starmer and your friends to sit down for a photo session with him. It's Larry Fink who's managing $11.5 trillion of global capital. And so the challenge that I see is that the PSLV silver is being held in a government vault, and the government is beholden to the financial sector, not to the populace at large. So that's the challenge that I see, Mario, is that it's the old thing again. The investors that hold the ETFs pretend to own silver, and the ETFs appear, 90% of them appear to be pretending to hold silver for the shareholders as well. And I think this is going to resolve itself in the marketplace.
Very good. So we're going to keep an eye on your work, David, and really interested in seeing how the implied lease rates evolve in the next month or two, and also the premium in Shanghai and in India. And I'd like to thank you for your time and wish you a happy new year.
Same to you, Mario. My Substack is jensendavid.substack.com for those who want to climb aboard and have a look. And it's a free full access Substack. So my concern is to have people to be able to understand and digest this information as we go forward. So it's going to be an interesting and I suspect a little bit of a wild 2025.
Thank you very much, David, and take care.
Thank you. Great talking to you.